If you are an NRI living in the US and you are blindly maxing out your 401k just because your HR department or your coworkers told you to, you might be walking directly into a massive financial trap. Most people look at accounts like the 401k, the Roth IRA, or the HSA as boring retirement buckets. But today, we are changing that narrative completely. These accounts are not just for when you are 65 years old. They are strategic chess pieces. They are tools that let you decide exactly when you pay taxes on your hard-earned dollars. There is a brutal financial reality that many professionals learn the hard way. Not understanding the strict lock-in laws of these US accounts can be incredibly costly. If anyone tries to cash out a portion of a traditional retirement account early because they need quick liquidity, the IRS doesn't just ask nicely for their tax share. They hit the account holder with a brutal 10% early withdrawal penalty on top of regular income tax. It is a mistake that causes thousands of dollars of hard-earned savings to vanish into thin air simply from not knowing the rules of the cross-border game. Protecting hard-earned capital from these unnecessary penalties is critical. This risk is twice as high for us as NRIs. Why? Because our lives are dynamic. You might stay in the US forever, or you might pack your bags next year to move back to Bangalore, Hyderabad, or Pune. If you move across borders without a concrete account roadmap, the tax double whammy between the IRS and the Indian Income Tax Department can completely destroy your wealth. By the end of this video, you will know exactly how to split your monthly investable income across 4 major US accounts, how they shift your tax timing, and precisely how they behave if you choose to return to India. Let's dive in. The core theme: controlling your tax timing. Here is the core philosophy you need to memorize. An investment account is not an investment. An account is simply a legal basket. The stocks, index funds, or ETFs you buy inside that basket are the actual investments. The true superpower of choosing one basket over another is controlling your tax timing. Every dollar you earn from your US tech or corporate job can be taxed at one of 4 times. It can be taxed now, it can be taxed later, it can be taxed along the way, or it can be taxed never. Your job as an NRI is to look at your monthly paycheck and distribute your money across these 4 distinct tax windows to give yourself ultimate lifestyle flexibility. Deep dive: the 4 tax answers account. 1. Traditional 401k. The later basket. Let's start with the most common account in America, the traditional 401k or 403b. This represents the later strategy. When you contribute to a traditional 401k, the money is taken directly out of your paycheck before the government touches it. If you earn $150,000 a year and you invest $20,000 into your traditional 401k, the IRS pretends you only earned $130,000. You get an immediate, massive tax break today. The money inside this basket grows completely tax deferred. You can buy, sell, and rebalance your portfolio, and you won't pay a single cent in capital gains tax. However, the catch happens at the finish line. When you reach retirement age, which the IRS defines as 59 and a half, and you begin withdrawing that money, every single dollar that leaves the account is taxed as ordinary income. For NRIs, the 401k has a golden rule. Always invest up to your employer match, but think twice before maxing it out completely. If your company matches up to 4% of your salary, that is an instant, guaranteed 100% return on your money. Take it every single time. But if you have no intention of staying in the US until you are 60 years old, piling every spare dollar beyond the match into a traditional 401k locks your liquidity behind an expensive IRS penalty wall. Account 2, the Roth IRA, the now basket. Next up is the ultimate wealth shield, the Roth IRA. This represents the now strategy. With a Roth account, you do not get a tax break today. You take money that has already been fully taxed out of your checking account and invest it. Because you took the tax hit upfront, the IRS makes a massive compromise. Every single dollar of growth, compounding, and eventual withdrawal after age 59 and a half is 100% tax-free. Imagine contributing $7,000 a year to a Roth IRA. Over 25 years, that money compounds into a massive fortune. When you withdraw it in retirement, you keep all of it. Not a single dime goes to the government. Now, many high-earning NRIs in tech or medicine face a hurdle here. If your income is over the IRS threshold, you cannot contribute to a Roth IRA directly. But you can use a legal, highly effective strategy called the Backdoor Roth IRA. You contribute to a traditional, non-deductible IRA first, and then instantly convert it into a Roth IRA. It is a completely legal loophole that every high-earning expat should utilize. Account 3. The HSA, Health Savings Account. The Never Basket. Now let's talk about the holy grail of American personal finance. The Health Savings Account, or HSA. This is the Never strategy, and it is the only account in the United States that offers a triple tax advantage. First, your contributions are 100% tax deductible, reducing your income tax today, just like a 401k. Second, the money grows completely tax-free inside the account. Third, and here is the magic, if you withdraw the money to pay for qualified medical expenses, the withdrawals are 100% tax-free. Most people treat the HSA like a spending account for doctor visits. They spend it immediately. That is a massive mistake. The secret strategy is to pay for your current medical bills out of pocket, keep your receipts, and leave the HSA money fully invested in broad US index funds for decades. It turns into an untouchable, pure growth wealth machine where taxes are paid never. Account 4. The Taxable Brokerage Account, the Along the Way basket. Our final bucket is the standard taxable brokerage account through platforms like Fidelity, Vanguard, or Charles Schwab. This represents the Along the Way strategy. This account has absolutely zero special tax shields. You invest post-tax money. Along the way, if your stocks pay dividends or you sell an asset for a profit, you must pay taxes on those capital gains and dividends in the exact tax year they occur. So, why would an NRI want this? Simple. Total freedom. Registered retirement accounts like the 401k or Roth IRA have heavy age walls. If you want to achieve financial independence early, retire at 40, buy a luxury apartment in India, or fund a sudden life transition, the taxable brokerage account allows you to withdraw your money at any time, for any reason, with zero penalties. It is your ultimate liquidity buffer. The strategic milestone timeline. To make this plan work, you cannot look at these accounts in isolation. You need to map them to an execution timeline based on your life stages. The Master NRI Account Phase Plan, Phase 1. High friction accumulation, 5 to 10 years. Maximize match and shields. Phase 2. The Cross-Border Transition, RNOR window. The Golden 3-year tax shield. Phase 3. Global Financial Independence, Retirement. Strategic multi-bucket pulls. During your accumulation years in the US, your order of operations must be strict. Don't scatter your money randomly. Fill the buckets sequentially. First, hit your employer 401k match. Second, max out your HSA for that triple tax advantage. Third, max out your Roth IRA or Backdoor Roth. Only when those tax-sheltered buckets are full, should your spillover monthly investable income flow into your taxable brokerage account. Remember the core lesson here. If you don't line up your timeline correctly and you raid retirement buckets during an international move, early withdrawal penalties will derail your compounding engine. Treat registered accounts as a permanent foundation and use a taxable brokerage as a flexible cross-border bridge. The master strategy, the return to India tax playbook. Now, let's address the most critical question for every NRI. What happens to these 4 accounts if you decide to pack your bags and move back to India permanently? This is where most people get overwhelmed, but it is actually highly manageable if you understand 3 core legal frameworks. The India-US Double Taxation Avoidance Agreement, DTA, the resident but not ordinarily, resident, RNOR, tax status, and the IRS rules for non-resident aliens, NRA. Let's break down exactly how each account is handled when you step off the plane in India. The traditional 401k India exit route. If you leave the US, you do not have to liquidate your 401k. In fact, Liquidating it all at once is a tax disaster because the IRS will hit you with top-tier US tax brackets plus that 10% penalty. Instead, you leave it sitting safely in the US to continue compounding. Under the India-US DTA, pensions and retirement annuities are generally taxed only in the country where you reside when you withdraw them. Furthermore, India's Income Tax Act provides a massive relief. It ensures that the income compounding inside your US retirement account is not taxed in India on an accrual basis. You are only taxed when you actually withdraw the money. When you turn 59.5 and begin taking regular monthly distributions from your 401k while living in India, the US will typically deduct a standard withholding tax. You can then claim a foreign tax credit, FTC, on your Indian tax return to prevent paying tax twice on the same dollar. The Roth IRA India exit route. The Roth IRA is an absolute gem for a returning NRI. Because the US-India DTA recognizes the tax-deferred status of retirement accounts, your Roth IRA can continue to sit in the US and compound completely undisturbed while you live in India. Because qualified Roth withdrawals are entirely tax-free on the US side, they represent an incredibly clean pool of capital. To ensure India doesn't try to tax the withdrawals as regular income, you must carefully track contributions and utilize disclosure schedules under the Indian black money and foreign asset reporting rules. The core corpus built with post-tax US dollars remains yours. The HSA India exit route. The HSA becomes slightly restrictive once you leave the US. Since you can no longer be enrolled in a US high-deductible health plan, you cannot make new contributions. However, the existing balance remains yours to invest. If you withdraw HSA funds while living in India to pay for medical expenses, verifying and mapping Indian medical receipts to satisfy IRS guidelines can be an administrative headache. The smarter approach? Treat the HSA purely as a traditional IRA. Once you turn age 65, the penalty for non-medical withdrawals drops to zero. You can then withdraw the funds for any purpose, paying regular income tax on the distributions just like a standard retirement account. The Taxable Brokerage account. The ultimate NRI hack. This is where the magic happens for returning NRIs. If you move back to India, you must notify your US brokerage and transition your account into an international brokerage account or a non-resident alien NRA account. Other conditions that may apply, like this, may not be applicable for green card holders or citizens. Once you are officially classified as a non-resident alien by the IRS, a spectacular rule kicks in. The United States does not charge capital gains tax to non-resident aliens on US stocks and mutual funds. Let that sink in. If you hold a portfolio in a US taxable brokerage account and you sell those stocks for a massive profit while living in India, you pay 0% capital gains tax to the US government. Now, what about India? This is where your RNOR, resident but not ordinarily resident status, becomes your ultimate financial superpower. When you first move back to India after living abroad for many years, you qualify for RNOR status for up to 2 to 3 financial years. Under RNOR rules, any income that originates outside of India, including capital gains from selling your US stocks, is 100% exempt from Indian income tax. Do you see the loophole? During your 3-year RNOR window in India, you can sell your US stocks inside your taxable brokerage account, pay 0% tax to the US because you are an NRA, and pay 0% tax to India because of your RNOR status. You can step up your cost basis entirely tax-free, liquidate your portfolio without friction, and use those clean dollars to purchase real estate or invest directly into Indian mutual funds. This is a multi-$1,000 strategy that very few expats know about. Tax diversification and final takeaways. At the end of the day, true financial independence isn't about finding a single perfect account. It is about tax diversification. If you put all your money into a traditional 401k, you are locked down by age walls and future income tax. If you put all your money into a taxable brokerage, you are bleeding wealth to taxes along the way. But when you build a portfolio that holds a traditional match, a robust Roth shelter, a triple-advantaged HSA, and a flexible taxable brokerage bridge, you give yourself total control over your financial destiny. You can choose exactly which bucket to pull from each year to manage your tax brackets, stay within the lowest possible tax limits, and smoothly transition your wealth across international borders without getting crushed by compliance. Start looking at your monthly investable income as a tool to control your tax timing. If you found this cross-border breakdown helpful, hit the subscribe button, drop your questions in the comments section below, and I will see you in the next video on NRI Roots and Returns.